Imagine owning a modern drilling rig, a machine so large and specialized that every operating day can appear to generate a small industrial fortune. From a distance, the business looks beautifully simple. Buy the rig, rent it to an oil company, collect the day rate, and repeat for years. That fantasy feels credible because the asset is visible, expensive, and obviously productive, unlike software, branding, or a promise written on a presentation slide. But the first ownership mistake appears immediately. Controlling the drilling rig does not necessarily mean controlling the oil, gas, or mineral rights beneath the ground. The rig owner, the oil and gas operator, and the mineral right holder may be three completely different parties with separate contracts and separate claims on cash. The contract driller owns the industrial system, while the operator decides where to drill, how much capital to spend, and whether the well proceeds. A surface landowner may control access to the site, yet still own none of the minerals, the drilling equipment, or the future production revenue. A lender may hold a secured claim against the rig, receiving interest in principal before the equity owner sees a distributable dollar from operations. Service companies provide fluids, directional tools, casing, cementing, transportation, and specialized support, while regulators define the legal, environmental, and safety boundaries of daily operations. The rig owner can receive a day rate without owning one barrel produced from the completed well because the asset sells industrial service, not underground reserves. The oil and gas operator makes a resource development bet, spending capital today in hopes that a future well produces commercially valuable oil or natural gas over time. The drilling contractor makes a different bet. It must keep equipment, crews, logistics, maintenance, and contracts aligned closely enough to create billable operating time. One party is exposed to the reservoir, the other is exposed to utilization, downtime, contract terms, maintenance discipline, and customer capital spending decisions over time. An idle rig still consumes insurance, maintenance, storage, and financing, proving that expensive equipment can generate costs even when it produces no operating revenue. So the real question is not whether the rig earns a large day rate, but how much survives the entire ownership system built around it. The day rate is the first number everyone notices because multiplying it across hundreds of operating days creates a revenue figure large enough to dominate the story. But a calendar day is not automatically an operating day. An operating day is not always billed fully, and a billed day is not immediate cash. When the rig performs contracted work normally, it may earn the full operating rate, making utilization appear simple until the contract introduces alternative payment states. A customer delay may trigger standby treatment, equipment failure may trigger a repair rate, and extended downtime can reduce the payment sharply or entirely. The calendar continues moving while payroll, insurance, maintenance, and interest continue arriving, even when the headline day rate has quietly stopped applying to the rig. This gap between contractual price and realized revenue is where ownership economics begins, because every reduced rate day weakens the contribution available to cover fixed obligations. Mobilization creates another adjustment, since the rig must be dismantled, transported, rebuilt, inspected, and commissioned before the next full operating day can officially begin. If mobilization is poorly reimbursed, the contractor may consume several future days of margin before the new drilling assignment produces its first normal invoice. Termination clauses matter because a long contract may provide visibility while still allowing the customer to leave early under conditions that reduce expected value. A protected contract may include compensation, while a weak contract can transform an impressive backlog figure into a schedule of work that may never become cash. Backlog helps managers estimate future contracted activity, but it is not a vault containing collected money, guaranteed utilization, or guaranteed profit for equity owners. It may exclude mobilization, reimbursement, incentives, optional extensions, reduced rate periods, and other items that materially change what the contractor ultimately earns and actually collects. The useful question is therefore not the maximum printed day rate, but the economic day rate after downtime, standby, mobilization, contract conditions, and customer collection delays. Two contracts with the same headline rate can produce very different owner outcomes because timing, protection, reimbursement, and customer concentration shape the cash result. The contract does more than set price. It determines when the rig behaves like a revenue-producing business and when it remains an expensive obligation. Most people see the mast first, but the mast is only the most visible component of a much larger industrial operating system. A complete drilling business includes the rig structure, power generation, hoisting equipment, circulation systems, controls, transport modules, maintenance access, and safe operating connections. The mast, substructure, drawworks, top drive, rotary floor, pipe handling, mud pumps, and mud tanks must function together as one coherent asset. Walking capability adds another layer, allowing the complete rig to move between wells on the same pad without being fully dismantled and transported. Even a mechanically complete rig cannot produce billable time without trained crews who operate, inspect, repair, coordinate, and protect the equipment continuously. Drillers, floor hands, derrick hands, mechanics, electricians, supervisors, safety personnel, logistics teams, and field support convert expensive machinery into reliable, repeatable, billable operating capacity. Behind the site, maintenance yards hold spare parts, repair equipment, technicians, inventory, and preparation systems that keep the active fleet commercially ready. The contractor also needs contracts, insurance, billing, payroll, procurement, information systems, compliance processes, and customer relationships before steel can reliably become collected revenue. Customer acceptance matters because a rig may work mechanically while lacking the horsepower, automation, pressure capacity, mobility, emissions profile, or crew history required. This creates a crucial distinction between physical life and economic life. Equipment can continue functioning long after customers stop valuing its specifications. The complete ownership unit begins with the physical asset, including steel, pumps, generators, controls, pipe systems, transport modules, and every required site connection. The second and third layers are the human system and commercial system. Crews create operation, while contracts, insurance, reputation, and billing create monetization. The fourth layer is the capital system, combining equity, debt, working capital, replacement reserves, and liquidity needed to keep every other layer connected. Remove one layer and the others quickly lose value. A rig without crew, contract, maintenance, or liquidity becomes an expensive scheduling problem. What the owner buys is not simply a machine, but a chain of obligations that must remain connected long enough to create billable time. The purchase price is usually the first number buyers see, but it rarely represents the full amount of capital required to own and operate the rig. An illustrative $30 million rig may still require spare parts, drill pipe, mobilization, commissioning, insurance, startup systems, initial working capital, and contingency reserves before operation. Those additional needs can push the modeled total capital requirement to $35 million, even before the asset earns its first normal operating day. This is not an industry average because rig class, age, specifications, condition, included equipment, and contract status can change the number dramatically. The point is structural. Purchase price is only one layer, while total capital includes everything needed to make the asset commercially ready and financially survivable. Suppose equity investors contribute $14 million, secured debt provides $17.5 million, and a working capital facility supplies another $3.5 million. The owner may say this structure controls a $35 million operating system, while the lender sees collateral, payment schedules, covenants, and priority over cash. Equity may control the company, but it does not automatically receive the first dollar generated by the rig once commercial operations officially begin. Payroll, vendors, insurance, interest, principal, maintenance, and working capital all stand ahead of equity in the practical priority order of recurring cash obligations. This makes equity the residual claim, meaning the owner receives only what remains after the operating system and its capital providers are paid. Debt can make the acquisition possible, but it also makes idle days more dangerous because payment schedules continue regardless of customer delays or utilization. An unleveraged rig can wait through weak periods while absorbing storage, insurance, maintenance, and opportunity cost without also facing mandatory principal repayment. A heavily financed rig must satisfy lenders even when contracts pause, repairs extend, or customers postpone work, shrinking the owner's ability to wait. Two owners can operate identical rigs at identical day rates, yet the one with lower leverage and stronger liquidity owns a very different economic asset. The physical equipment may look the same, but one owner has optionality and the other has a countdown governed by debt and fixed obligations. The primary revenue engine is the operating day rate, paid when the rig, crew, and operating system perform contracted work under the agreed commercial conditions. That payment is tied to industrial service and operating time, not to ownership of the oil or gas the completed well may later produce. Mobilization revenue may compensate the contractor for dismantling, transporting, rebuilding, inspecting, and commissioning the rig successfully before normal operations begin at the new site. Demobilization payments may apply when the assignment ends, helping recover the cost of removing equipment, crews, and support systems from the location safely afterward. Standby rates may compensate the contractor when the rig remains available, but cannot operate because the customer, site, permit, or program is not ready. Performance incentives may reward faster drilling, fewer unproductive hours, better reliability, or other measurable operational outcomes that create additional value for the customer. Technology services can add revenue through automation, data systems, remote monitoring, or specialized drilling support bundled together with a physical rig and operating crew. Some contracts reimburse damaged, lost, or consumed equipment, but these payments may restore value already lost rather than create recurring economic profit for owners. Revenue quality depends especially on contract duration, customer credit, termination protection, mobilization treatment, payment terms, concentration, and rules governing reduced rate periods over time. A short contract may offer flexibility but little visibility, while a longer contract may improve planning, yet lock the contractor into unattractive pricing for years. Customer concentration increases risk because one operator reducing its drilling budget can idle several rigs, weaken pricing, and enlarge the cash flow gap at once. Collection timing matters because the rig can operate today, invoice later, and receive cash weeks after payroll, parts, transport, and insurance were already paid. This delay means the contractor finances the customer during the receivable period, using its own liquidity or borrowed working capital to bridge daily operations. Reactivating more rigs can increase revenue potential while also expanding payroll, inventory, mobilization spending, receivables, and field support costs before cash collection finally catches up. A high-quality revenue stream therefore combines commercial relevance, protective terms, manageable concentration, timely collection, and enough pricing to cover the complete ownership system profitably. Revenue enters through the contract, then the cost stack begins removing it through labor, maintenance, logistics, insurance, overhead, capital obligations, and working capital. Labor is the most visible operating cost, including wages, payroll taxes, benefits, overtime, travel, housing, training, supervision, and the expense of replacing experienced workers. Labor can decline when activity falls, but cutting too deeply may increase future hiring, training, downtime, and operational risk when demand eventually returns. Maintenance is another major layer because pumps, engines, top drives, controls, electrical systems, and pipe handling equipment all wear under demanding operating conditions. Routine maintenance is predictable, but a failed component can trigger emergency transport, specialist labor, replacement equipment, and several days of reduced or zero billing. Deferred maintenance does not eliminate cost. It converts a visible expense today into a higher probability of larger repairs, lost revenue, and weaker asset reliability tomorrow. Transportation and logistics add cost because every move requires dismantling, loading, trucking, cranes, permits, escorts, rebuilding, inspection, and commissioning before revenue resumes. Insurance remains another fixed obligation, covering property, equipment, liability, workers, vehicles, and interruption risks even when utilization falls and revenue becomes uncertain. Maintenance yards support the active fleet through storage, tools, inventory, diagnostics, repairs, and preparation. Although the yard itself never earns a drilling day rate, corporate support adds engineering, dispatch, procurement, information technology, cybersecurity, accounting, legal, safety, sales, and executive management above the direct cost of one rig. Direct operating margin is useful because it shows whether field activity contributes money, but it excludes many obligations that still stand between operations and owner cash. Depreciation is non-cash today, yet the machinery is physically wearing out. So ignoring replacement needs can overstate the sustainable economics of the fleet. Sustaining capital preserves existing capability through engine, pump, control, pipe, and structural replacement, while growth capital adds capacity and must remain analytically separate. Interest compensates lenders, principal returns borrowed money, and both consume cash even when accounting profit appears acceptable or operating utilization temporarily weakens. The complete cost stack extends below the rig floor, leaving owner cash only after labor, maintenance, logistics, overhead, debt, capital, and working capital are funded. Now consider one illustrative land rig, using a simplified model designed to explain the cash bridge rather than represent an industry-wide average. Assume an operating day rate of $36,000 and 320 billable days during the year, both clearly stated as modeled assumptions. Multiplying those assumptions produces $11,520,000 of modeled annual revenue before any operating cost or financing obligation is deducted. Next, assume direct operating cost averages $19,800 for each billable day, covering crews, field support, routine maintenance, and logistics. Across 320 billable days, modeled direct operating costs reaches $6,336,000 for the entire operating year. Subtracting direct operating costs from revenue leaves $5,184,000 of direct margin before overhead, debt, capital, and working capital. That direct margin sounds impressive, but it is still only the contribution available to support the rest of the company and its capital obligations. Assume $700,000 for fleet and corporate overhead, covering engineering, dispatch, procurement, systems, legal support, and management above the rig. Then reserve $1,200,000 for sustaining capital, including major repairs, component replacement, and preserving the rig's commercial capability. Add $1,500,000 of cash interest and $1 million of principal repayment required by the illustrative capital structure. Then include $200,000 of taxes and fees, plus $300,000 of additional working capital absorbed before customer cash arrives. Together, all deductions below direct margin total $4,900,000 in this illustrative annual owner cash bridge before distributions occur. After those deductions, modeled distributable owner cash is approximately $284,000 from more than $11.5 million of revenue. Reduce billable days from 320 to 280, and modeled owner cash becomes negative by roughly $364,000. The modeled cash break-even sits near 303 billable days, roughly 83% utilization, showing how a small calendar change can erase equity returns. The owner trap begins with a true statement. A working rig can generate substantial direct margin, but that margin does not automatically belong to equity. Direct margin belongs first to the business because it must support every obligation that was not charged directly to the operating rig. A strong margin per active day can show field efficiency, yet it still excludes corporate overhead, interest, principal, working capital, and sustaining capital. The first mistake is therefore simple. Direct margin is treated as distributable owner cash before the rest of the ownership system is funded. The second trap is treating an active rig as fully utilized, even though mobilization, customer delays, repairs, and contract gaps can interrupt billing. The third trap is treating backlog as collected cash, despite conditions, exclusions, termination rights, mobilization periods, and performance requirements that can change realized value. The fourth trap is treating oil prices as direct rig revenue, even though the contractor is paid for service time rather than commodity ownership. Higher oil prices may encourage more drilling, but operators can also repay debt, complete existing wells, acquire acreage, return capital, or simply wait. The fifth trap is assuming book value equals market value, even when customer preferences shift and older specifications lose commercial relevance before physical usefulness ends. The sixth trap is treating a stacked rig as free optionality. Although storage, inspection, maintenance, crew rebuilding, and reactivation all require money. Reactivation can demand parts, software updates, transportation, testing, customer acceptance, and working capital before the rig earns its first full-rate day again. The seventh trap is treating maintenance capital as optional because postponing replacement can make current cash look stronger while the underlying asset becomes weaker. The eighth trap is assuming growth automatically improves liquidity, even though more active rigs can expand payroll, inventory, receivables, and mobilization spending before collection. The owner trap appears when analysis stops at the first attractive metric, instead of following every deduction from revenue down to distributable cash. Revenue is not profit. Direct margin is not EBITDA. EBITDA is not free cash flow. and free cash flow is not always owner cash. The failure engine usually begins outside the rig company when operators reduce drilling budgets and fewer contracted wells are available for the fleet. Lower demand first creates contract gaps, forcing rigs to wait between assignments, while payroll, insurance, maintenance, storage, and debt obligations continue. As idle time expands, annual utilization falls, reducing realized revenue faster than many fixed and semi-fixed costs can adjust downward. Weaker utilization also weakens pricing power because multiple contractors compete for fewer programs and customers demand discounts, protection, or more flexible terms. Lower day rates reduce contribution per active day, meaning every remaining operating day must support a larger share of fleet overhead and capital obligations. Management may respond by cutting crews, inventory, training, and maintenance, preserving cash temporarily while weakening the system required for a reliable recovery. Experienced workers then leave for steadier employment, making reactivation slower, more expensive, and operationally riskier when customer demand eventually returns. Deferred maintenance increases hidden wear, so the next contract can begin with more failures, more repair days, and less customer confidence. That weaker reliability creates additional downtime, which reduces billing, consumes parts and specialist labor, and damages the contractor's commercial reputation. A damaged reputation can exclude the rig from preferred customer programs, shortening contract duration and pushing the asset toward weaker pricing tiers. Meanwhile, receivables may remain outstanding, while payroll, vendors, insurance, interest, and principal require cash, compressing liquidity during the downturn. If liquidity tightens enough, the company may draw revolving credit, delay vendors, sell equipment, issue equity, or renegotiate debt under pressure. Those actions can protect survival, but they may increase interest, weaken supplier trust, dilute owners, or surrender future upside to new capital providers. The failure engine becomes circular. Lower demand reduces utilization, weaker cash reduces maintenance, weaker reliability reduces contracts, and fewer contracts reduce cash again. A drilling contractor rarely fails from one bad day. Failure emerges when several manageable pressures reinforce each other faster than liquidity can absorb them. The downside rarely begins with a dramatic collapse. It begins with time, as an expensive asset waits while contractual revenue disappears. During idle periods, payroll can shrink, but insurance, storage, maintenance, financing, inspections, and basic asset preservation continue consuming cash. Stacking rig reduces activity, yet every month of inactivity can weaken readiness, disperse crews, age components, and enlarge future reactivation work. When demand returns, reactivation may reveal hidden corrosion, expired certifications, obsolete software, missing parts, and a crew that must be rebuilt. If several contractors reactivate simultaneously, competition can return faster than demand, limiting pricing recovery even while reactivation costs are still being paid. The accounting value may remain high while the market value falls because buyers price current specifications, contract visibility, condition, and financing risk. A lower market value weakens collateral coverage, giving lenders more influence precisely when the owner has less liquidity and fewer strategic choices. Covenant pressure can then transform an operating problem into a financing problem, forcing cash preservation, negotiations, asset sales, or new equity. Selling a rig during a weak market may raise liquidity, but the price can reflect urgency, limited buyers, transport cost, and uncertain contract value. Rescue capital can stabilize operations, yet existing owners may accept dilution, tighter controls, preferred claims, or a smaller share of any recovery. The downside also reaches workers, suppliers, communities, and customers through layoffs, delayed payments, reduced local activity, and weaker service continuity. Safety, maintenance quality, environmental controls, and worker rights cannot become margin levers. Cutting them transfers financial pressure into unacceptable operating risk. The same ownership logic becomes more severe offshore, where an ultra-deepwater drill ship combines larger capital commitments, specialized crews, and expensive downtime. Downside resilience therefore comes from liquidity, contract protection, maintenance discipline, customer diversity, and conservative capital structure, not from the headline day rate alone. The owner does not control the cycle. The owner controls only how much financial and operating resilience exists when the cycle turns. Owner cash is the residual money available after operations, overhead, debt service, taxes, sustaining capital, working capital, and a realistic reserve policy are funded. The calculation begins with collected operating cash, not headline revenue, signed backlog, loan proceeds, customer deposits, or unrealized appreciation in the rig. Collected cash must then be reconciled with receivables, because growth can increase reported revenue while consuming liquidity before customers actually pay invoices. Direct operating costs come next, including crew compensation, field support, routine maintenance, transportation, insurance allocations, consumables, and contract-specific operating requirements. Fleet and corporate support must also be funded, even when engineering, dispatch, procurement, accounting, compliance, and management cannot be assigned neatly to one rig. Owner labor requires normalization because an owner who manages contracts, financing, hiring, operations, and customers is performing work that has an economic replacement cost. Ignoring that replacement cost converts unpaid owner labor into apparent profit, making the business look more distributable than it would under professional management. Sustaining capital must preserve the rig's commercial capability through major repairs, component replacement, control upgrades, and structural work required to remain competitive. Working capital changes can either release cash or absorb it, depending on receivables, inventory, vendor timing, mobilization spending, and the pace of fleet activity. Debt service then removes interest and principal according to financing agreements, regardless of whether accounting depreciation or EBITDA makes the period appear profitable. Taxes, fees, insurance reserves, and contingency liquidity must be recognized before distribution, because a thin cash balance can turn one ordinary disruption into distress. Only after these claims are funded does the distribution decision begin, and even then lenders, covenants, board policy, or upcoming maintenance may restrict payment. A strong operating year can therefore produce modest distributions if working capital expands, debt amortizes quickly, or management rebuilds reserves after earlier weakness. A weaker year may still preserve ownership value if liquidity remains adequate, maintenance is funded, customers stay diversified, and the capital structure avoids forced decisions. Owner cash is not the largest number in the model. It is the smallest defensible residual that can leave without weakening the operating system. The upside begins when demand, pricing, reliability, and utilization improve together, allowing the same capital base to produce more contribution without proportional cost growth. Higher utilization spreads fleet overhead, insurance, support systems, and maintenance infrastructure across more billable days, improving economics even before day rates rise. Stronger day rates then increase contribution per active day, but only when contract protections, payment terms, and reduced rate rules preserve the realized value. Reliable equipment creates a second advantage by reducing repair days, protecting customer confidence, and keeping expensive crews productive instead of waiting. Maintenance discipline therefore supports upside twice. It avoids lost billing today and extends the commercial usefulness of the rig tomorrow. Customer diversity strengthens the revenue base because one budget cut no longer threatens the entire fleet, pricing position, and working capital plan. Longer protected contracts can improve planning, crew retention, purchasing, and financing, provided the contractor does not lock itself into unattractive economics. Technology can raise value through automation, data, remote monitoring, and more consistent performance, but only when customers pay for measurable outcomes. As cash generation strengthens, management can repay debt, reducing interest, principal pressure, covenant risk, and the amount of revenue required for survival. Lower leverage converts operating improvement into strategic flexibility, allowing the owner to wait, maintain assets, reject weak contracts, or fund selective growth. Working capital can also release cash when receivables collect faster, inventory normalizes, and mobilization spending declines after the fleet reaches steady operation. A disciplined reserve policy prevents temporary success from becoming over-distribution, preserving liquidity for repairs, reactivation, customer delays, and the next downturn. The best upside is therefore not a single high-revenue year, but a stronger system that produces cash while becoming less fragile. When utilization, contract quality, maintenance, liquidity, and capital structure reinforce each other, the ownership loop becomes constructive instead of destructive. In that condition, the rig is more than productive steel. It becomes a resilient operating platform capable of converting demand into durable owner cash. The conditional verdict is straightforward. A drilling rig becomes an attractive ownership asset only when the operating system is stronger than the cycle around it. A high day rate helps, but contract protection, collection timing, mobilization treatment, and customer credit determine how much of that price becomes usable cash. A modern high-spec rig helps, but specifications create value only when customers need them, crews can operate them, and maintenance preserves their reliability. Utilization must remain comfortably above cash break-even, because operating near the threshold leaves equity exposed to ordinary repairs, delays, and contract gaps. Leverage must remain conservative enough for the company to survive weak demand without sacrificing maintenance, accepting destructive contracts, or issuing emergency equity. Liquidity must cover payroll, vendors, mobilization, receivables, and unexpected repairs before distributions are considered, especially when customer payment arrives after operating costs. Maintenance reserves must reflect physical wear and commercial obsolescence, not merely accounting depreciation, because tomorrow's reliability is financed with today's retained cash. Customer diversity must reduce dependence on any single operator, basin, or budget cycle, while contract quality protects pricing and termination economics. Management must normalize owner labor, taxes, sustaining capital, debt service, and working capital before calling any residual amount distributable owner cash. Under those conditions, the rig can convert specialized steel, skilled labor, contracts, and capital into a durable stream of residual cash. Without those conditions, the same rig becomes a leveraged obligation whose value depends on refinancing, asset sales, or a perfectly timed market recovery. The difference is not the photograph of the machine. It is the invisible system of contracts, liquidity, maintenance, people, and capital surrounding it. This verdict is therefore conditional, not a recommendation to buy or sell any company, rig, security, or private business interest. The ownership case strengthens when utilization has a buffer, contracts protect realized value, leverage declines, maintenance remains funded, and customers stay diversified. It weakens when debt dictates decisions, cash depends on perfect utilization, maintenance is deferred, and headline revenue hides a fragile residual. The final paradox is that the more impressive the rig appears, the easier it becomes to overlook the fragile economic system required to keep it productive. Ownership grants control over steel, crews, contracts, and capital, but also makes the owner responsible for every hour when those resources fail to earn enough cash. The rig can look valuable because it is large, specialized, and expensive, while the owner's residual remains small, delayed, conditional, and uncertain. A busy rig can still weaken the company if pricing is poor, collections are slow, or maintenance and working capital consume the apparent margin. An idle rig can preserve future option value, but only when liquidity, maintenance discipline, crew planning, and customer relevance survive the waiting period. The owner therefore manages two clocks: the operating clock that measures billable days and the capital clock that measures how long cash can support the system. When the operating clock moves faster than the capital clock, debt falls, reserves grow, and the owner gains time, bargaining power, and strategic flexibility. When the capital clock moves faster, liquidity shrinks, lenders gain influence, maintenance becomes harder to fund, and ownership begins losing practical control. This explains why control on paper can coexist with economic dependence on customers, lenders, workers, suppliers, regulators, and the condition of the asset. The physical rig belongs to the company, but its productive value is continuously rented from reliable crews, protected contracts, maintained equipment, and available liquidity. The owner may hold the residual claim, yet that claim receives value only after every stakeholder required for safe operation has been compensated. In strong periods, the system can hide weak discipline because rising demand, higher utilization, and easier financing temporarily cover mistakes in capital allocation. In weak periods, the same mistakes become visible as downtime, covenant pressure, deferred maintenance, distressed sales, dilution, and disappearing owner cash. The durable ownership advantage is not predicting every cycle, but building enough contractual, operational, and financial resilience to remain solvent through ordinary uncertainty. The paradox is simple. Owning the rig means possessing the asset, while earning from it depends on continually funding everything the asset cannot provide by itself. The final test is not whether the rig looks productive, but whether the complete ownership system converts operating activity into durable residual cash. The owner controls the rig company, yet revenue still depends on customers, crews, contracts, maintenance, lenders, regulators, and reliable field execution. Money enters primarily through operating day rates, mobilization, standby treatment, technology services, incentives, and reimbursements governed by specific contract terms. Money leaves through labor, logistics, maintenance, insurance, overhead, debt service, taxes, sustaining capital, working capital, reserves, and normalized owner labor. The difference between those flows is not automatically distributable because liquidity, covenants, upcoming repairs, and board policy can still restrict owner payments. A healthy ownership system keeps utilization above break-even with enough buffer to absorb ordinary delays, repairs, mobilization, and contract gaps. It also protects realized pricing through customer credit, termination rights, payment timing, mobilization treatment, and disciplined contract selection. Conservative leverage preserves time because lower debt pressure allows management to maintain equipment, reject weak terms, and wait through softer demand. Maintenance discipline protects both current billing and future commercial relevance, preventing temporary distributions from quietly consuming the productive asset. Safe operation, environmental controls, maintenance quality, and worker rights remain fixed boundaries, never acceptable shortcuts for improving reported margin. When these conditions reinforce each other, the rig can generate cash, reduce debt, rebuild reserves, and strengthen bargaining power across the cycle. When they weaken together, the same asset can consume liquidity, lose contracts, defer maintenance, trigger financing pressure, and dilute existing owners. The offshore comparison changes the scale, not the logic. Larger capital, specialized crews, and expensive downtime make every ownership mistake more consequential. So the verdict remains conditional, analytical, and specific to contract quality, utilization, asset condition, liquidity, capital structure, and management discipline. The rig is visible, but owner cash is residual. Sustainable ownership comes from funding the invisible system that keeps both alive.